Well, g'day there, everybody. Thanks a lot for joining me on this Thursday afternoon market recap. We do have quite a lot to go through. Really, what has taken place over the past 48 hours in response to the US midterm elections has been a very positive outcome for the markets. The Dow, especially between Tuesday and Wednesday, it closed up just over 450 points. And naturally, the same percentage types of moves, if not more, have occurred on the Nasdaq and also the S&P 500 during the same time frame. Now, what has taken place? I've received a lot of emails over the past really 24, 48 hours asking, hey, has the analysis shifted? What's going on? Is the market going to continue moving higher? So I thought, hey, why don't I just address it all as at the close on Thursday, give it an additional day's worth of price action to move through before we start formulating our response moving forward. And that is exactly what I am going to do for you right now. Hopefully break this down, lay the foundation to a lesser extent as to what to expect tomorrow being Friday, but more importantly, what should happen during the month of November. And that's exactly what I'm going to do for you now. I'm also going to touch on our top 12 individual trade lists because as it stands, we've got some really perfect type of basing patterns which are starting to form when it comes to the individual stock analysis. But really what's going to push those individual stocks into that really nice formation as they continue to sell off, relatively speaking, back into macro support and develop some of these double bottoms and at least reversal patterns for that next legitimate push higher is that of, well, what's going to happen on the US indexes themselves. So the first maybe 5 minutes or so I'm going to dedicate to the update of the US financial markets, followed by moving into our top 12 individual trade lists. Now, the major really theme, I guess, of our analysis towards the back end of October was the beginning of this open window. First of all, we took advantage of the correctional move. We were largely anticipating it. We closed most of our bullish trades that we had been in really since really the earlier period of 2018 up at these two targets, 26,309 and 26,435. This is when we were starting to see really false signals on the ADX and also the commodity channel index up and around respective all-time highs. So we were fortunate enough to liquidate and get out of the market and then, of course, take those bearish trades. We didn't capture the entirety of the move. We got out more or less down towards support, especially on the S&P 500, but you always miss out the entirety of the move. So don't think that you can always time it 100%, okay? Each of these sort of correctional movements and also the revert back. But what's going on at the moment is that although October, it was another seasonally very weak month, what we began to notice, right, towards the very last session of October was that we were beginning to print an open window. An open window through to the current juncture that still needs to be filled. It was looking as though last Friday where we started to see this sort of high wave spinning top candlestick here, this dark candlestick, really begin to suggest, well, hey, this might be the move to come on back down and close this open window. That wasn't the case. We stabilized on Monday. We had the US actual, midterm election results. And then, of course, we saw the major pop take place on Wednesday. Most of this week's gains, even through to today's session, really happened and occurred on Wednesday. But what is very glaringly obvious and staring you right at the face is that not only do we have one open window that still retrospectively needs to be filled, but we also have a secondary open window now that is developed between that of Tuesday and also Wednesday. So as I look at this bullish move, although we can say, hey, we've retraced a fair amount of this bearish sell-off and we have done it in very quick time as well, I'm very hesitant about this bullish move, and personally, I still think it is that of a fake move, and I'm going to explain why that is. If you cast your mind, and again, I'm going to need to go back sort of retrospectively, and a great example of this is really towards the first 1 to 2 months of 2018, and it was when the markets themselves were absolutely ripping to the upside, okay? It was not until the first trading session, all right, in the month of February where things started to begin looking relatively weak. And the reason why I say that is because, yes, we did see a gap towards the second, if not third, late stage of the trading calendar for the month of January. But that's where we established the waterfall sell-off, which ultimately this is when a lot of people started to turn bearish on the market. We, however, we're starting to begin actually buying longer-term positions down around the support. And I'm going to ask you the question, why was that? Okay, why were we waiting for the base to set up? And then why did we want to trade in the bullish direction? And obviously, I cannot hear your response. But the reason for that, okay, is because of this open window. And if you understand technical analysis, really technical analysis is just a process. It's a repeating process. It's never identical, but it generally follows very similar patterns. And one of the strongest patterns that I've come to realize, right, in the world of trading the financial markets is that when you open windows, especially on market indices, those windows will be closed. And it always comes down to the question, well, how long is it going to be until this window closes? But my best response that I can give people, and again, I find myself responding to a bunch of emails at the moment, rightfully so, where people are really proposing, okay, the same question: when are these windows going to close? And what I can say, and what I've really developed over many years of trading, is that if we sort of zoom back on out and come back into the current juncture over here, what will happen, okay, prior to breaking out and taking out a new all-time high, is that these windows will need to close. So when you think about this bullish move rallying off from, 24,500, here we are up at 26,200 almost, you have to say and at least acknowledge and understand and be patient enough to wait for this move, simply to say that, look, not only this window is going to close at 25,750, but this market and these markets collectively, not only on the Dow, but also on the S&P and the NASDAQ, are going to give back all of this rally here over the past 1.5 weeks, really dating back to the gap out that established on Tuesday, all right? All of this is going to be given back prior to the markets themselves collectively breaking out and creating a new all-time high, and then trending further into the 2019 calendar year. So when I look at this, I ask myself the question, do I want to get involved? Say, for instance, retrospectively, I wish I did jump in at 25,304 and I was just simply taking profits at the moment. And I mean, am I upset? No, not really, because I understand that the way this works and the way this overlaps really nicely at the moment with the individual trade setups is that we are perfectly aligned and positioned for the markets to pull on back down, to close both of these open windows at the moment. And then that is essentially turning the page on this chapter of the correction. At the moment, I'd say we're probably 60% through the correction. And the last 30% or the last 40% is going to be this last final exhaustion type of wave. The sentiment, the public discourse is going to turn very bearish when this happens. You're going to see a lot of media reports being wrote suggesting that, look, all of the good news post-election is actually negative news. And if you sort of think about it, if the market turns negative post-election, it's going to look as though the market really doesn't like the midterm results. But that is not the answer. The answer is simply that in order for this market to continue above the all-time highs, pardon me, I'm stuttering a little bit, is that we need to close these open windows. So really right now, I'm not bothered whatsoever that the markets are rallying and pushing off to the upside. What does become concerning, however, and this is very important to understand, is that if this market doesn't come on back down to close these open windows, the market becomes more bearish. I mean, as crazy as what that is to hear, let me just repeat myself. If we do not come on back down and really close these open windows in the month of November, I will start turning exceptionally bearish on the markets, because what is most bullish for the market, and it might sound a little sort of counterintuitive at the moment, what would be the most bullish foundation for this market long-term moving forward to actually see weakness flow in, to close these windows, to see the dip buyers ultimately hold support, and then to see a natural continuation out of these macro support areas. Anything in this area right here is radioactive. You do not want to be touching trades. You do not want to be going long the Qs or the SPYs, the diamonds. This is not the right opportunity down here. A lot of trading, all right, is just waiting around and being patient for the right entry opportunities. And I'm telling you, even if you break this down on a risk and reward basis, even if you're trying to find sort of or justify anyway, just taking market positions at current levels just for the upside and expecting this move to just break out above the all-time highs, I'm telling you the probability of such a move is exceptionally low, i.e., I'm not banking on it, I'm not trading on it, I'm not going long, not at these current levels. I am very much so bullish on the markets. However, I'm happy enough to wait, to sit, and enter at the right opportunities that I deem to be fit, or at least fit my analysis when it comes to, trading the US financial markets. And very rarely is this analysis off. Very rarely do we get it wrong. Sometimes the market does act, rather odd, or at least there is a little bit of market noise out there. I think this week, especially this week, it's really exacerbated by the midterms and, of course, the Fed speaking today. They are not navigating away from rate hikes, by the way. And truly, I don't believe that is a problem at the moment. It will become a problem more so into 2019. But for the time being, the market doesn't care. All right. And that's the simple reality of it. The market doesn't care. But in order for us to turn the page, in order for us, right, to advance into the next chapter, all right, of the story of the market, we have to see certain things happen. And one of those things are these windows being closed. Okay. It's glaringly obvious. A lot of people don't pick up on it. And what they do instead is just simply buy the market at the wrong opportunity, at the wrong price, right? Not at the right support areas, if not at support whatsoever. And they pay the consequences once the market naturally does what it needs to do. And what I'm suggesting right now is that, look, if you're not in the market, if you're not positioned in the market, try not to give into the temptation of missing out, the FOMO effect, the fear of missing out, because right now is a very dangerous location on the charts. Not only are we pushing back up into resistance, but we're also, moving off a very extended type of push higher, a V bottom that isn't really showing up in the right location. And when you see these types of foundations laid, they are exceptionally weak. This is not an advance off from a sustainable support area. At least temporarily, it may look like it is, but really it's not. That's what I'm really trying to say right now. And please don't get upset if you're sitting there saying, hey, I'm missing out on these gains. These gains are going to be given back, all right? Mark my words. These gains are going to be given back. And just as they are more or less all given back, that is when we will jump on into these markets all the way back down at these lower areas, 25,000 on the Dow. And again, if we have a look, relatively speaking, on the S&P 500, 2,700 on the S&P 500. We have about over 105 points for the S&P to fall once ultimately it begins to do so. And then, of course, on the NASDAQ, 7,125. That looks to me where that open window is. You can take your pick whether or not you want to jump into the Qs, the diamonds, or the SPYs. But again, a lot of risk if you're thinking about entering into the market, if you entered into the market post, of course, Wednesday or during the session on Wednesday and during today's session today, I'd encourage you to rethink that and really just to break it down on a risk and reward basis, notwithstanding, of course, any understanding of the open windows that are most important at this current juncture. All right, so I hope that sort of sums up my analysis, my understanding of the markets. I am macro and intermediately bullish on the markets. Again, we traded bearish in the month of October. We were talking about it for a very long time since we really began to break down and more or less just tread water during the month of September. I was saying, hey, something's not right. Something's not right. What did we do? We traded bearish. Now I'm telling you, I'm bullish. However, we need to wait a little bit longer to get the best possible entry price. All right, so we're just going to have to sort of sit with it, stick with it, and we'll move with it, all right, into the second week of trade for the month of November. Now, let's jump into a couple of trades. Apple is one of those. We did not have a trade on Apple. Over the weekend, we spoke about the whipsaw developing. Let me ask you the question, has the whipsaw developed to the downside? And the answer to that question is yes, it has. Anyone who placed short trades below 205 are now underwater. Got a very quick sell-off. However, we did stabilize and we're pushing back up into retesting 215. Once this takes place, all right, it does set the stage for another drop back down to close ultimately Apple's open window down here at 191. So I just wanted to give you an update on that particular stock. We've got Amazon racing up at 1,750. Again, what this is setting the theme for, or at least the chart pattern for, is that of a W for winner, i.e., a double bottom. So pay attention to this. We've got the doji candlestick today. We'll see what happens of it, but at the same time, we're retesting an old support area as new resistance. Volume on this bullish move is completely falling out of Amazon. Pay attention to that as well. So when this, and if this does come back down to 1,500, that is going to be the last opportunity for something like this to happen. Let's talk about Boeing Airlines. We are not in Boeing Airlines at the moment, simply waiting for it to come on back down, potentially to work in conjunction with the markets prior to moving higher. Not a whole lot I can update you on that particular stock. Baidu, this is great. It's falling for that secondary sort of exhaustion wave back into support. So we spoke about this over the weekend, 185. If you can get this at 180, it will become an absolute steal. You can see the bearish candlesticks developing. This looks to at least be pricing lower prices or wanting to actually print lower prices. So you can see, again, a little bit of material weakness when it comes to a couple of these individual companies already. We've got Caterpillar, which has closed its open window. We got the gap out yesterday, which did establish that of a hangman at resistance, and we've got the bearish candlestick today. So this isn't the nicest of potential W's or the beginnings of double bottoms, but if we do see this sell on off and not print a lower low, this is going to be a fantastic trade to jump on into, all right, very, very soon. Now is not the time. You do not want to be buying Caterpillar up around this level. The reason I say that is because we're more or less back at this critical retest, very similar to Apple, what I just spoke about being support, turn resistance, and that is going to be met with a flood of supply coming back into the market. Now, one of the stocks that is a little bit more developed is COP. Okay, and the reason I say that is because today we had a very nice long day Morobozu candlestick. A long day Morobozu candlestick, which is at least setting the momentum to come all the way back down to $64, $65 a share. When we see this, we're going to be back at macro support, and hopefully this is going to align at some later date with this rising trend line. The trend line going all the way back to 2016. So I'm really liking the setup on COP. It is a little bit more advanced as to what we're currently seeing on a bunch of other trades. But you can see how these stocks are positioning to fall once again. This is going to coincide with the market selling off back down, or not all the way back down to support, but to close both of those windows, and then that is going to be the opportunity to go long these trades. CVX, surprise, surprise, it's come all the way back on up, back down into this sort of descending, all right, bearish trend line, and we've got the reversal candlestick setting up right now. Let me just clear something up, by the way. Do I want to trade bearish on individual trades and also the market at this time? And the answer to that question is no, not really. I'd rather trade in the direction of the underlying trend, understanding that the trend itself is assumed to be in effect. And I'm talking about the macro trend since 2009 until it gives us definitive signals that it has reversed. We have no such signals whatsoever. So if anything, CVX is looking to make another wave rotation down to 108. But ultimately, if the markets do break out, CVX should break out also above its respective resistance areas. We've got Google, surprise, surprise, making that or forming that of a really ugly sort of double bottom. What it hasn't done, however, is really established a major sort of directional breakout at this time. You can see the open window. On Google, it did close. What happened, it was met with buying. We got the gap out again between Tuesday and Wednesday, but the handbrake was pulled during Thursday's session of trade. So this is a stock that wants to get moving. It is too premature, however. You just need to give this a little bit more time. I would not take the 118 trade, all right? Simply, I would not take it. I'm removing this 100% and waiting for the market to recalibrate at lower prices, and that's most likely going to be probably a multi-month low on Google as well. And this is going to coincide with Apple and Amazon and Boeing Airlines and Caterpillar, more importantly Baidu, and a pretty decent segue, of course, into IBM at the moment, because IBM is something we've been very interested about. This takes us all the way back to 1993, this bullish sort of trend that has been in effect. Ultimately, unfortunately, I think this is going to break probably towards the back end of 2019, the trend line itself. But for the time being, we're starting to really print out of a rounding sort of Japanese dumpling bottom, which is really good. Consider IBM the same as Baidu. So when we spoke about Baidu, we're talking about the secondary retest of this trend line and also macro support. But when you think of it in the context of IBM, it's very, very similar. And you can see again, if I was to draw something like this, that would make a lot of sense. Very rarely do you see movements like this. And this is exactly what we're seeing on the US indices at the moment. That's why I'm very hesitant and I'm being a little bit constructive in my analysis as to why I'm not going anywhere near them. All right, so expect this to fall. We have a little pseudo shooting star candlestick, but pretty healthy. I mean, we've got 4 bullish candlesticks, something that we haven't seen consecutively for the price of IBM in a number of months. So, I mean, there is a little bit of life in this, and life is coming off the trend line back in 1993. I've had a few people actually email in and say, hey, jumped into IBM off the trend line just because it was at that multi-decade trend line. I said, hey, a little bit risky, but you've taken it. Let's see how it plays out. To you and to those people who did, congratulations. That is a pretty profitable trade, just trading off from that long-term trend line. Now, if we move into Netflix again, look at this open window. We've got a rise on low volume. What I haven't been speaking about in today's class, or at least this recap, so to speak, is volume coming out on these bullish bounces. And that is something to pay attention to. We've got the bearish reversal candlestick between Wednesday and Thursday. We had that nice white Morobozu candlestick on Tuesday and Wednesday. Really, that just flooded, markets everywhere and also individual companies. But this is not out of the woods at the moment. Wouldn't surprise me to see Netflix come all the way back down to 290 at this point in time. What will we have? We'll have another W in the formation once we close, and price may even potentially set up the first higher low moving forward. So I'm liking the constructive nature of these individual trades. They're just simply not ready to jump into at the moment. So I hope I'm addressing concerns, questions, queries, and we're just nailing them all at the moment. Now, the final stock that I wanted to speak about was Tesla. Tesla's drifting higher. We haven't had a trade on Tesla for really quite some time now. 321 down to 303. We did that ultimately in 1 day, or 2 days really. We actually gapped over the 303 target. If I show you this, the actual open of this trade was 291. So a better representation of this was really about a $28 move between the entry and then, of course, the closure the following day if you use conditional orders. But since then, we've had earnings and it has been rather volatile. We've had a little bit of a mess, so to speak, fundamentally, and a lot going on with Elon Musk and you know, some of his tweets he's posted recently. It all seems to have sort of relatively cleared up. The stock itself is doing okay. It's recalibrating, but I pointed this out over the weekend. To me, this looks like sort of a rising wedge pattern just here. So if we start to break really below the low of Tuesday's candlestick, if not the low of Monday's candlestick this week, watch out, because this is going to fall like a rock and it's going to coincide with the markets as well. So I hope that's sort of, I guess, giving you a better understanding of what I'm looking for in the markets and why I'm so confident just to really sort of sit here and just observe from the sidelines. It's only when things really align and make sense where you want to allocate capital. You don't want to allocate capital just for the thrill of it. Otherwise, you won't last all that long as a trader. You just simply won't. You'll wash out, unfortunately, just because there's not enough criteria and rules to govern, of course, your trading actions, right? In the directions, pardon me, that you're choosing to take. So if I could give any guidance whatsoever, it would be to just remain patient. Understand and believe in the concept that open windows, especially on market indices, need to close. They're rife across all three of our closely followed markets. I'm flipping through them now, and until they close, this market is going to be met with a ton of supply. Once this sort of first wave of exuberance begins to sort of pitter, after and post the election results, the midterm results. But ultimately, this market is going to drift higher into 2019 and maybe, who knows, even into the first quarter of 2020. That's a long sort of observation and forecast. But again, the calendar year of 2019 is setting up really nicely. When you think about it, the US financial markets have been in a consolidating type of state. Over the last 11 months on the NASDAQ, we're only up 627 points. On the Dow, we're only up 1,400, which is still a big move in and of itself. But really, it's not all that great compared to some of the more recent years that we've established and printed. And on the S&P 500, we're up 133 points. Let me remind you, the majority of these points have come in the last 1.5 weeks. So for the majority of 2018, if you look back on where we were, where we came from, right, we have been largely unchanged as at really 1.5 weeks ago. And again, a lot of the prints at the moment have been made, the net positive prints at the moment have been made over the past 1, if not 1.5 weeks. All right, so that's going to do us as at this Thursday afternoon market recap, a little bit longer than what I, ideally want to speak about. My apologies for that. Enjoy your Thursday evening, everyone. I'll be back with you. Actually, I'll see you most likely in Pro on Saturday. We'll see what happens on Friday. But if not, I'll see you in that Pro analysis class on Saturday as we go into this in more comprehensive detail. All the best, everyone. James signing off on behalf of Pivot Point Trading. Goodbye.